For most of modern history, the most powerful weapon in global competition was assumed to be armies, oil, or technology. Yet quietly, without a single dramatic announcement, one country accumulated something far more abstract and far more influential. Claims on other nations' money reaching into the trillions, so large that even its own officials seemed uneasy discussing the full implications. Because the uncomfortable truth is that this stockpile was not built through conquest or theft, but through a system the rest of the world willingly participated in, believing it was neutral, efficient, and even beneficial, unaware that the incentives embedded inside it would slowly tilt the global economic balance. To understand how China came to hold over $3 trillion in foreign currency reserves at its peak, we need to step back to the late 20th century, when China was not yet perceived as an inevitable superpower, but as a vast, underdeveloped economy emerging from decades of isolation, with limited capital, outdated infrastructure, and a leadership haunted by one central fear: instability. The memory of hyperinflation, social unrest, and political collapse was not theoretical for Chinese policymakers. It was lived experience, and this fear shaped every major economic decision that followed. When China began opening its economy in the late 1970s and accelerated reforms in the 1990s, it faced a dilemma common to developing nations but magnified by scale: how to grow rapidly without losing control. The solution they pursued was deceptively simple but structurally profound. Tie growth to exports, keep the currency stable and competitive, and build credibility by never appearing financially fragile. In practice, this meant managing the value of the renminbi tightly against the US dollar, the world's dominant reserve currency, at a time when global trade was exploding and multinational corporations were searching relentlessly for lower production costs. By keeping its currency relatively undervalued, China made its exports cheaper and more predictable, turning itself into the workshop of the world. But this policy had a mechanical consequence that few outside central banking circles fully appreciated. Every time China sold more goods abroad than it bought, foreign currency flowed in. And to prevent that inflow from pushing up the renminbi and undermining export competitiveness, the central bank had to intervene, buying those dollars and other currencies and issuing domestic money in return. Over time, this was not a choice, but an obligation imposed by the policy itself, and the result was an ever-growing mountain of foreign exchange reserves, mostly in US dollars, accumulating year after year. From the outside, this looked like extraordinary financial strength, a sign of discipline and success. But inside China, it was understood as both shield and constraint. The reserves acted as insurance against crises, a lesson learned from watching other Asian economies collapse in the 1997 financial crisis, when capital fled and currencies imploded. But they also locked China deeper into the existing dollar-centered global system, forcing it to recycle its export earnings into U.S. Treasury bonds and other dollar assets, effectively lending back to the consumer economies that were buying Chinese goods. This circular flow created one of the defining economic relationships of the modern era. American consumers spent, Chinese factories produced.
And Chinese savings financed American deficits, a system that seemed stable precisely because it spread responsibility so widely that no single actor felt fully accountable for its risks. Psychologically, this arrangement exploited a powerful human bias known as status quo comfort. As long as growth continued and crises were avoided, there was little incentive for any participant to fundamentally change behavior, even if long-term imbalances were obvious. For China, the accumulation of reserves became both a symbol of sovereignty and a source of anxiety, because holding trillions in foreign currency meant exposure to decisions made elsewhere, especially in Washington, where monetary policy was driven by domestic priorities rather than Chinese interests. The 2008 global financial crisis was a turning point in how this reality was perceived. When the United States responded to the crisis with massive stimulus and unconventional monetary policies, expanding its balance sheet dramatically, Chinese officials watched the real value of their dollar holdings fluctuate with decisions over which they had no control, crystallizing a fear that had always been latent, that their hard-earned reserves could be diluted by inflation or policy shifts abroad. Yet, paradoxically, the crisis also reinforced China's position. Because as global investors sought safety, U.S. treasuries remained the primary refuge, and China, as one of the largest holders, found itself more deeply embedded in the system and mistrusted. This is where the notion of a currency play becomes less about cunning manipulation and more about structural leverage. China did not corner the global market by declaring dominance. It did so by becoming indispensable to its functioning. Its reserves gave it influence in subtle ways, shaping expectations, calming markets during periods of volatility, and signaling stability to trading partners and investors. At the same time, the sheer size of these reserves constrained China's own policy freedom, because selling them too aggressively could destabilize markets and harm its own economic interests, a classic example of power that cannot be exercised without self-damage. Over the years, Chinese policymakers experimented with ways to reduce this dependence, promoting the international use of the renminbi, establishing currency swap lines, and investing reserves in real assets through sovereign wealth funds and overseas projects. But each step was incremental, reflecting a deep awareness that rapid change in a tightly interconnected system can trigger unintended consequences. From a psychological perspective, the accumulation of reserves can be seen as an institutional manifestation of loss aversion. The pain of potential instability was weighted far more heavily than the opportunity cost of holding low-yield assets, leading to a strategy that prioritized safety and control over efficiency. This mindset also shaped how China responded to external criticism, particularly accusations that it was deliberately manipulating its currency for unfair advantage. While there were periods when policy choices did favor exports, the broader picture is one of a country navigating a complex transition, balancing domestic employment, social stability, and global integration, often choosing the path that minimized immediate risk even if it entrenched long-term dependencies. The global impact of the strategy was profound. By anchoring its growth to exports and reserves, China reinforced the dollar's central role while simultaneously highlighting its vulnerabilities, contributing to global imbalances that economists debated but rarely resolved. Other countries, observing China's apparent success, adopted similar reserve accumulation strategies, leading to a world awash in savings seeking safe assets, compressing yields, and altering investment behavior across continents. This feedback loop illustrates how individual policy choices, when replicated, can reshape the entire system, often in ways no single participant intended. As China's reserves approached and then exceeded $3 trillion, the conversation shifted from how they were built to what they meant for the future of global finance. Were they a tool of influence, a buffer against shocks, or a sign of a system so skewed that such hoarding was rational? The answer, uncomfortably, is all three. The reserves embody trust in existing institutions and simultaneous doubt about their fairness, confidence in integration, and fear of exposure. They've represented a bet that stability could be engineered through scale, that sheer size could compensate for uncertainty, an assumption that mirrors a broader human tendency to equate accumulation with security. Yet, history suggests that systems built on imbalance rarely resolve without adjustment, and adjustment often arrives through channels no one fully anticipates. In recent years, as China's reserve levels stabilized and even declined somewhat, reflecting capital outflows, currency management changes, and efforts to rebalance the economy toward domestic consumption, the narrative of relentless accumulation has softened. But the legacy remains embedded in the architecture of global markets. The $3 trillion were never just money. They were claims, expectations, and promises linking households, governments, and institutions across the world. Understanding how they came to be is less about attributing blame or celebrating strategy, and more about recognizing how incentives, fear, and coordination problems shape outcomes on a planetary scale. In the end, the most unsettling realization is not that one country managed to corner a vast portion of the global currency market, but that it did so by following rules and incentives that everyone else accepted, revealing that the true power of the system lies not in any single actor's intentions, but in the quiet momentum of structures we rarely question until they have already reshaped the world.